The train is leaving the station, and if you're not on board, you're going to watch from the platform as one of the greatest wealth transfers in modern history unfolds without you. I'm not being dramatic. I'm reading the signals that most people are completely missing right now, and what I'm seeing should terrify anyone who's worked their entire life to build a nest egg. Let me paint you a picture of what's happening right now in the gold market. While the mainstream financial media is busy talking about tech stocks and cryptocurrency, something extraordinary is taking place in the oldest form of money known to humanity. Central banks around the world are buying gold at a pace we haven't seen in over half a century. Not just buying it, hoarding it, stockpiling it like they know something the rest of us don't. The World Gold Council just released data showing that central banks have been net buyers for multiple consecutive years now, and the pace is accelerating. We're talking about hundreds of tons being pulled out of the market every single quarter. China's central bank, Russia's central bank, India, Turkey, Poland. Even countries you wouldn't expect are loading up on physical gold, like their economic survival depends on it. And here's the thing that should make you sit up and pay attention. These aren't amateur investors. These are the most sophisticated financial institutions on the planet, run by people who have access to information you and I will never see. So why are they doing this? What do they know that the average American retiree sitting on a portfolio of stocks and bonds doesn't know? The answer is both simple and terrifying. They're preparing for a monetary reset, a fundamental restructuring of the global financial system, and they want to make sure they're holding real assets when the music stops. Think about what's happened over the past few years. We've seen inflation rates that were supposed to be impossible in modern economies. We've watched the Federal Reserve print more money in a shorter period than at any time in American history. We've seen the national debt explode to levels that would have been considered catastrophic just a generation ago. And we've witnessed the beginning of something that financial historians will talk about for the next 100 years, the de-dollarization of the global economy. Countries that have relied on the US dollar as the world's reserve currency for decades are now actively working to reduce their dependence on it. The BRICS nations, Brazil, Russia, India, China, and South Africa, are developing alternative payment systems. They're settling trade in their own currencies. They're building financial infrastructure that bypasses the dollar entirely. And every single one of them is backing these efforts with one thing: gold. Now, before I go any further, I want to share something with you. I've put together a free guide that breaks down exactly what's happening in the precious metals market and why thousands of American retirees are using these strategies to protect their wealth. You'll find it in the description below. It's completely free, and it might be the most important financial document you read this year. Grab it while you're thinking about it, because what I'm about to share with you is going to make a lot more sense once you understand the full picture. Let's talk about what's happening with supply and demand, because this is where things get really interesting. Gold mining production has essentially plateaued. We're not finding massive new deposits like we did in previous decades. The easy gold has already been pulled out of the ground. What's left requires more energy, more capital, and more time to extract. Meanwhile, demand is surging from every direction. Central banks buying, institutional investors buying, retail investors in Asia buying. And here's the kicker. Physical gold is being pulled out of the major trading hubs at an alarming rate. The COMEX, the major commodities exchange in New York where gold futures are traded, has seen its registered gold inventory, that's the gold that's actually available for delivery, drop to levels that would have caused panic just a few years ago. We're talking about a market where the amount of paper gold, futures, contracts, and derivatives dwarfs the amount of physical gold that actually exists to back those contracts. It's a system built on leverage and confidence. And when confidence starts to crack, that's when you see price movements that defy all conventional analysis. Look at what happened in the London bullion market. For years, this was the center of the global gold trade, massive amounts of physical gold moving through London vaults. But recently, we've seen unprecedented outflows. Gold leaving London and heading east, to Switzerland, where it's being refined and shipped to Asia, to China, where it disappears into private vaults and central bank reserves. This isn't just a trend, it's a tectonic shift in where the world's gold is being held and who's controlling it. And here's what most people don't understand about gold. It's not just a commodity. It's not just a shiny metal that people like to wear as jewelry. Gold is a monetary asset. It's the only form of money that doesn't depend on someone else's promise to pay. When you hold physical gold, you're not holding a piece of paper that says someone owes you something. You're holding the asset itself. No counterparty risk, no default risk, no risk that the institution backing your investment is going to collapse and take your wealth with it. Think about your retirement account for a second. If you're like most Americans, you've got a 401k or an IRA that's invested in stocks, bonds, maybe some mutual funds. All of those are paper assets. They're claims on future earnings, promises that companies will be profitable, that governments will pay their debts, that the financial system will continue to function the way it has for the past several decades. But what if those promises start to break down? What if the assumptions that your entire retirement plan is built on turn out to be wrong? We've seen it happen before. In 2008, people who thought they had secure retirements watched their account balances get cut in half. Stocks that were supposed to be safe, blue-chip investments collapsed. Financial institutions that were considered too big to fail had to be bailed out by the government. And the people who suffered the most were the ones who were closest to retirement, who didn't have time to recover from those losses. They had to either delay retirement, go back to work, or accept a dramatically reduced standard of living for the rest of their lives. Now, I'm not saying we're about to see a repeat of 2008. What I'm saying is that the risks in the financial system today are different, and in many ways more severe than what we faced back then. We've got geopolitical tensions that are higher than they've been in decades. We've got a level of government debt that makes the 2008 crisis look manageable by comparison. We've got inflation that's eroding purchasing power faster than most people's investments can keep up. And we've got a generation of retirees who are completely dependent on a financial system that's showing cracks in its foundation. This is where gold comes in, not as a get-rich-quick scheme, not as a speculation, but as insurance, as a way to make sure that no matter what happens to the dollar, no matter what happens to the stock market, no matter what happens to the banking system, you've got a portion of your wealth in an asset that has held its value for thousands of years, an asset that central banks are buying, an asset that has survived every financial crisis, every currency collapse, every economic catastrophe in human history. Let me tell you a story that illustrates this perfectly. Back in the 1970s, we had a period that's eerily similar to what we're seeing today. High inflation, loss of confidence in the dollar, geopolitical instability, and gold went from $35 an ounce to over $800 an ounce in less than a decade. People who had the foresight to move a portion of their wealth into gold during that period didn't just preserve their purchasing power, they multiplied it. While their neighbors were watching their savings get destroyed by inflation, gold owners were sitting on gains that changed their financial lives. But here's the thing that most people miss about that period. The real gains didn't come from timing the market perfectly. They came from recognizing the trend early and positioning yourself before the crowd figured it out. The people who made life-changing returns on gold in the 70s weren't the ones who bought at the absolute bottom. They were the ones who recognized that the fundamentals had changed, that the old rules didn't apply anymore, and that gold was going to play a different role in the financial system going forward. We're at a similar inflection point right now. The fundamentals have changed. The old assumptions about how the economy works, about how monetary policy works, about the role of the dollar in the global financial system, those assumptions are being challenged in ways that most people haven't fully grasped yet. And the smart money, the central banks, the sovereign wealth funds, the family offices that manage wealth for the ultra-rich, they're positioning themselves for what comes next. They're buying gold. Now, let me address something that I know some of you are thinking. You're wondering if you've already missed the move. Gold has already had a strong run. Is it too late to get in? And my answer is this: we're not even close to where this is going. The current price action is just the beginning of a much larger trend. When you look at gold relative to the money supply, relative to government debt, relative to the size of the global economy, it's still historically cheap. We're nowhere near the kind of valuations we saw at previous peaks. But more importantly, this isn't about trying to catch a short-term price move. This is about recognizing a fundamental shift in the global monetary system and making sure you're positioned on the right side of that shift. When central banks are buying hundreds of tons of gold every quarter, when countries are actively working to reduce their dependence on the dollar, when the physical gold market is showing signs of stress that we haven't seen in decades, Those are signals that something big is happening. And the people who recognize those signals early are the ones who are going to preserve and grow their wealth while everyone else is wondering what happened. Let me give you another historical parallel. In 1971, President Nixon closed the gold window, ending the direct convertibility of dollars to gold. It was supposed to be a temporary measure. It became permanent, and it fundamentally changed the nature of money. For the first time in history, the world's reserve currency was backed by nothing but faith in the US government. No gold backing, no commodity backing, just a promise. And for 50 years, that system has worked more or less. But the cracks are showing now. The debt levels are unsustainable. The money printing is out of control. And countries around the world are starting to question whether they want to continue holding their reserves in an asset that can be created out of thin air with no limit. That's why they're buying gold. Because gold can't be printed. It can't be created by a central bank with a keystroke. It can't be devalued by government policy. It exists in finite quantities, and it takes real resources to pull it out of the ground. In a world where trust in fiat currencies is eroding, gold is the ultimate safe haven. It's the asset that doesn't depend on anyone's promise. It just is. And here's where this gets really interesting for American retirees. Most people don't realize that you can hold physical gold inside a retirement account. A gold IRA allows you to take a portion of your retirement savings and invest it in physical precious metals while maintaining all the tax advantages of a traditional IRA. You're not taking a distribution. You're not paying penalties. You're simply diversifying your retirement portfolio to include an asset that has protected wealth for thousands of years. I've put together a comprehensive guide on how gold IRAs work, and it's available for free in the description below. It covers everything you need to know about getting physical gold into your retirement account without triggering taxes or penalties. If you've got $100,000 or more in retirement savings, this is information you need to see. Because what's happening in the gold market right now isn't just an investment opportunity, it's a chance to protect everything you've worked for from the risks that are building in the financial system. Think about what a market collapse would mean for your retirement. Think about what runaway inflation would do to your purchasing power. Think about what geopolitical instability could do to the value of paper assets. These aren't hypothetical risks. These are real threats that are growing more serious by the day. And the people who are taking action now, who are moving a portion of their wealth into hard assets like gold, are the ones who are going to sleep better at night, knowing that they've protected themselves against these scenarios. Now, let's talk about what's driving gold prices right now, because understanding the mechanics of this market is crucial to understanding where we're headed. On the supply side, as I mentioned, production has plateaued. The major mining companies are struggling to replace their reserves. The ore grades are declining, meaning they have to process more rock to get the same amount of gold. Energy costs are rising, making extraction more expensive. And the lead time from discovery to production for a new mine is measured in decades, not years. You can't just flip a switch and produce more gold when demand increases. On the demand side, you've got multiple powerful forces converging at the same time. Central bank buying, which I've already discussed, is at levels we haven't seen since the 1970s. But you've also got increasing demand from Asia, particularly China and India, where cultural affinity for gold runs deep and where rising middle classes are converting their savings into physical metal. You've got institutional investors who are starting to recognize gold's role as a portfolio diversifier and inflation hedge. And you've got a growing awareness among retail investors that the traditional 60-40 stock bond portfolio might not be adequate protection in the current environment. All of this demand is hitting a market where the available supply of physical metal is constrained. And that's creating a situation where the paper gold market, the futures and derivatives that trade on exchanges, is becoming increasingly disconnected from the physical market. You can see this in the premiums that physical gold commands over the spot price. You can see it in the delivery delays that buyers are experiencing. You can see it in the drawdowns of inventory at major vaults and exchanges. The physical market is tight, and it's getting tighter. What happens when you have surging demand hitting constrained supply in a market that's already showing signs of stress? You get price movements that shock people who aren't paying attention. You get the kind of explosive moves that we saw in previous bull markets. And you get a situation where the people who position themselves early are sitting on substantial gains while everyone else is trying to figure out how to get in. But here's the thing that separates successful investors from everyone else. It's not about having perfect timing. It's about recognizing when the risk-reward equation has shifted dramatically in your favor and having the courage to act on that recognition. Right now, the risk of not owning gold is far greater than the risk of owning it. The downside is limited. Gold has thousands of years of history as a store of value. It's not going to zero. But the upside, given the fundamental drivers I've outlined, is substantial. We could easily see gold move to levels that would have seemed impossible just a few years ago. And I'm not just talking about modest gains. I'm talking about the kind of wealth preservation and growth that can make the difference between a comfortable retirement and a struggling one, between financial security and financial stress, between being able to maintain your standard of living and having to make painful compromises. This is serious stuff. This is about protecting everything you've worked for over your entire career. Let me share another perspective that might help you understand the magnitude of what's happening. If you look at the total value of all the gold ever mined in human history, it's somewhere around $12 trillion at current prices. That sounds like a lot until you compare it to the size of global financial markets. The total value of global stocks is over $100 trillion. Global bonds are another 100 trillion plus. Global real estate is even larger. And the total money supply, if you include all the various forms of currency and credit, is in the hundreds of trillions. Now, what happens if even a small percentage of that wealth decides it wants to own gold? What happens if institutional investors decide they want to increase their gold allocation from 1% to 5%? What happens if sovereign wealth funds decide they want to hold more gold and fewer dollars? The math is simple. There isn't enough gold to go around at current prices. The only way the market can clear is through higher prices, much higher prices. This is what the central banks understand. This is why they're buying now, before the crowd figures it out. They're not trying to time the market. They're not trying to buy at the absolute bottom. They're accumulating a strategic asset that they know is going to be more valuable in the future than it is today. And they're doing it quietly, consistently, without fanfare, because they don't want to trigger the kind of buying panic that would drive prices up before they've finished building their positions. But you can see the evidence if you know where to look. You can see it in the import data from Switzerland, which shows massive flows of gold heading to Asia. You can see it in the COMEX inventory reports, which show declining stocks of deliverable gold. You can see it in the premiums that physical gold coins and bars command over the spot price. You can see it in the delivery delays that dealers are experiencing. The physical market is telling you something that the paper market hasn't fully priced in yet. And that disconnect creates opportunity for people who are paying attention. Now, I want to address something that comes up whenever we talk about gold. People ask, but gold doesn't pay interest. It doesn't pay dividends. How can it be a good investment? And that's a fair question that deserves a thoughtful answer. Gold isn't an investment in the traditional sense. It's not a productive asset. It doesn't generate cash flow. What it does is preserve purchasing power over time. It's insurance against the debasement of fiat currency. It's protection against the kind of monetary chaos that destroys paper wealth. Think about it this way. If you own a bond that pays 3% interest, but inflation is running at 7%, you're losing 4% of your purchasing power every year. You're getting poorer in real terms, even though your account balance is going up in nominal terms. Gold doesn't have that problem. Gold tends to maintain its purchasing power over long periods of time. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. Can you say the same thing about the dollar, about any fiat currency? The real question isn't whether gold pays interest. The real question is whether your current portfolio is adequately protected against the risks that are building in the financial system. And for most people, the honest answer is no. They're overexposed to paper assets that depend on the continued stability of a system that's showing increasing signs of stress. They're vulnerable to inflation, to currency debasement, to market crashes, to geopolitical shocks, and they don't have adequate protection against those risks. That's where gold comes in. Not as your entire portfolio, not as an all-or-nothing bet, but as a strategic allocation that provides insurance against the scenarios that could devastate a traditional stock and bond portfolio. Most financial advisors who understand the current environment recommend somewhere between 5 and 20% of your portfolio in precious metals. That's enough to provide meaningful protection without being so concentrated that you're taking on unnecessary risk. And here's something else to consider. We're living through a period of unprecedented monetary experimentation. Central banks around the world have engaged in policies that would have been considered reckless or impossible just a generation ago. Negative interest rates, quantitative easing on a scale that dwarfs anything we've seen before, direct monetization of government debt. These are not normal policies. These are emergency measures that have become permanent features of the financial landscape. And nobody really knows how this experiment ends. But we do know one thing. Throughout history, whenever governments have debased their currencies, whenever they've printed money to finance their spending, whenever they've engaged in the kind of monetary manipulation we're seeing today, gold has been the asset that preserved wealth. It happened in Weimar Germany. It happened in Zimbabwe. It happened in Venezuela. It's happened in every hyperinflationary episode in human history. And while I'm not predicting hyperinflation in the United States, I am saying that the risks are higher than most people recognize, and the prudent thing to do is to have some protection in place. Let me paint you a picture of what could happen over the next few years. Imagine a scenario where inflation remains stubbornly high, despite the Fed's efforts to control it, where government debt continues to spiral upward because neither political party has the will to make the hard choices necessary to bring it under control, where geopolitical tensions escalate and countries accelerate their efforts to move away from the dollar, where the physical gold market gets so tight that the paper market starts to break down, where investors wake up to the fact that the emperor has no clothes, that the financial system is built on a foundation of debt and promises that can't possibly be kept. In that scenario, what happens to gold? It doesn't just go up, it explodes. It becomes the asset that everyone wants and nobody wants to sell. It becomes the safe haven that investors flee to when everything else is falling apart. And the people who position themselves early, who recognized the signs and took action before the crowd, those are the people who not only preserve their wealth, but grow it substantially. Now I know some of you are thinking, this sounds too good to be true. If gold is such a great opportunity, why isn't everyone buying it? And that's actually a great question that gets to the heart of how markets work. The truth is, most people don't buy assets when they're cheap, and the fundamentals are strong. They buy when prices are already high and everyone is talking about it. They buy at the top, not the bottom. They follow the crowd instead of thinking independently. Right now, gold ownership among American investors is near historic lows. Most people have zero exposure to precious metals in their portfolios. The financial media barely covers it, except to occasionally mock gold bugs or question why anyone would own a barbarous relic. Mainstream financial advisors are still recommending the same 60-40 stock bond portfolios that worked in a different era, but might not be adequate for the challenges we face today. In other words, gold is unloved, underowned, and underappreciated. And that's exactly when you want to be buying. Think about the best investments you've ever made or heard about. Were they the ones that everyone was talking about? Were they the obvious consensus trades that had already made the headlines? Or were they the opportunities that required independent thinking, that required you to see something that others were missing, that required you to act when it wasn't popular or easy? The biggest returns come from being early, from recognizing value before the market does, from having the conviction to act when others are skeptical. That's where we are with gold right now. The fundamentals are screaming that this asset is undervalued relative to the risks in the financial system. The smart money is accumulating. The physical market is tightening. The geopolitical and monetary backdrop is more favorable for gold than it's been in decades. But the crowd hasn't figured it out yet. They're still chasing tech stocks and cryptocurrencies and whatever else is making headlines. And that creates opportunity for people who are willing to think differently. Let me bring this back to what matters most: your retirement, your financial security, your ability to maintain your standard of living no matter what happens in the economy or the markets. That's what this is really about. Not about making a quick profit or timing the market perfectly, but about making sure that you've protected yourself against the very real risks that could derail your retirement plans.